The stock market is volatile. Wall Street's been like a roller coaster. Yet some people have managed to discover other ways to get what they really want. So people ask, how can I get good returns and not risk the farm? The interest rates are at all-time lows, so people aren't really turning to CDs and bonds. Well, one option is called private placement programs in either real estate or other areas, but it's usually not an option for 90% of the population unless you have a certain larger net worth. Another common option is to accept the rigid terms of an insurance company and buy an indexed annuity. But that has limitations that can make it not the best idea in some situations. However, for many people, this could be a good option. I want to say you do need to be careful with annuities because they are very complex and hard to understand. Another option could be that you could get returns in the stock market. That does exist. So let me explain it. Normally, when you're invested in a certain diversified portfolio, you think in terms of, is this conservative or is this aggressive? And then you might have it occasionally rebalanced to keep that portfolio in alignment with your risk tolerance. So when I mentioned this next option, don't go down that pathway of thinking and think that what I'm about to say is the same thing, even though the portfolio would probably look almost the same. So the difference is in something called managing volatility. So you see, there's a method to managing investments that uses science and academic research to create a formula that goes into action and can reduce the wild swings. So this is important because the wild swings, managing the high highs and the low lows, actually reduce the efficiency of the invested money. Why? Because the lower the account goes, the more it has to rise to get back up there. So imagine that you're running a marathon. And you get to the 1 mile marker and your partner beside you needs to go use the restroom. She runs back to the start line to go to the bathroom. Yes, ladies, I used the she, sorry. And so you keep running. Does she need to run 1 mile to get back caught up to you, or more than a mile? More than a mile. So this is what happens when you get really high highs and really low lows. It's less efficient. So lack of efficiency costs you gains. So think of it as having a lesser squiggly line versus a bigger squiggly line. Retirees usually prefer a lesser squiggly line. They don't usually sit down with me and say, give me the squiggliest thing you got. Okay? So everything that I'm saying today is very common in the industry among academics. Some of the science behind it has to do with non-correlation, observing standard deviation, and observing specific economic data points, to name a few. So it's not mystical. But most portfolios, they're like the first one that I mentioned. They're very passive. They hardly ever get looked at. So I'm not recommending anything specific here. I'm simply showing you that there's some other ways to possibly get what you want. So my way of helping most people has been detailed in my 4-step framework video. So you might find the answers you're looking for there. You click on the link if you'd like to check that out. So can you get returns without risking the farm? I trust that this video showed you a few ways. Thanks for watching.